Hello and welcome, ladies and gentlemen. On behalf of Axis Bank, I welcome you all to this webinar on LIBOR transition. And yes, the big question that we are asking today is, are we ready? So my name is Ajit Lakra, and I will be your moderator for the day. Why are we hosting this discussion? Well, that's because we have been getting a lot of requests from all of you, our customers, to kind of help you decode this phenomena that we have been hearing about a lot, especially as we draw close to the transition deadlines. Well, if you ask me, this kind of reminds me of the Y2K phenomena where we all knew the jargon but didn't know exactly what actually the challenge was at hand. Thankfully, today the flow of information is so much more free-flowing than what it was a couple of decades back. So at least we don't have to wait till the last day to figure out the facts and maybe as well as the myths. So coming back to today's topic, LIBOR. LIBOR, as we see, is often referenced in loan derivatives and bond documentations and other types of documentation to calculate interest payments, purposes such as performance targets, benchmark for funds to value certain products, to calculate discount rates, performance ratios, and so on and so forth. So the list is basically endless. So it's pretty much evident that LIBOR is something which is really important, and its transition certainly needs to be talked about. I mean, just to give you a perspective, as we stand today, there are some 400 trillion of financial instruments linked to LIBOR. And I mean, just to contextualize that number, the global GDP is between 80 to 85 trillion dollars today. Well, to speak about the nitty-gritties of the history of LIBOR and how it came about to being, why it is such an important benchmark, what happened to all these needs, I mean, why it needs to change, and finally, how all these changes will impact us. That is what matters. So we have two robust knowledge powerhouses today with us to speak on this topic. Well, before we start, some housekeeping announcements. Participation in the webinar is by invitation only. So Axis Bank reserves the right to block access to any person to whom our invitation is not sent. And unauthorized dissemination of the contents of this webinar is strictly prohibited. And prior explicit permission of Axis Bank is imperative. And also, as a reminder to all participants, the viewing panels will be in the view-only mode. So participants who wish to ask questions may post them on the question box on your screens, please. Please note that this conference is being recorded and may involve the presence of the press or the media. Well, those are the couple of housekeeping announcements. Now, let me introduce you to our panelists for the day. Sumit Gupta, of course, he's from Axis Bank risk management team, and he's also a very critical member in the core LIBOR transition team of Axis Bank. And he has been one of the key influences in this project for the last 1 year or so. So we are really looking forward to kind of draw on that expertise and experience. Sumit is, of course, a veteran in the financial services risk management space and has worked with other major banks in India. And he also brings a significant amount of global experience, having worked in a global investment bank in London for 5 years. So his focus today will be to talk on technical aspects. He will be getting the micro bits of it. What will replace LIBOR? How will kind of potential breakdown of the hedges or the loans and those kind of stuff? And well, of course, the real powerhouse that we have and the privilege we have to have Mr. Subramaniam Oruganti. Subramaniam Oruganti, or Subbu, as his friends and colleagues really call him, is a partner in Ernst & Young India. And he has over 15 years of experience in financial services. Currently, he leads the quantitative advisory services with E&Y India, focusing on risk management, quantitative solutions like model development, validation, new regulatory programs like CCAR, FRTB, IBOR, IFRS 9. And he's been working with a lot of global investment banks, Asian banks, and Indian banks. Additionally, he's also IBOR transition leader for the region and has helped several banks in successful transition. So before this, Subbu has had stints with Credit Suisse, ICICI Bank, and Northern Trust, leading their model valuation team and being part of their risk management teams. So Subbu, it's a real privilege to have you here, and thank you very much for taking out time. Subbu will be speaking on the micro aspects of what is LIBOR, how does it impact the rate, which will replace LIBOR in the way ahead. Understanding the impacts in the Indian market, the broader Indian markets, the kind of impact that's going to have. Global market developments. These are some of the topics that Subbu will cover. So thank you once again to all our customers for being here. And I won't keep you waiting any longer. So on behalf of Axis Bank, thank you all once again for being there. And I now hand over the forum to Mr. Subramaniam Oruganti. Thank you all. And over to you, Subramaniam.
Hi. Thanks a lot, Ajit, for your nice introduction, and thanks a lot for Axis Bank for inviting me for this conference. So let me just share the screen. Yeah. So I hope it is visible to every one of you. A lot of people are talking about what is IBOR transition and why this transition is happening, etc. I think there might be people with different levels of understanding here. So let me start off the conversation with some background in terms of what is LIBOR in the first place. So when I say LIBOR, I'm actually not referring to one rate. It is the rate across 5 different currencies and 7 different tenors. And effectively, it is a pooled rate that is given across 35 rates that are quoted on a daily basis. And to give you some background, sorry, yeah, sure. Okay. Yeah. So when we say LIBOR, so we are talking about 35 different rates that are quoted on a daily basis. And a little bit background about this LIBOR transition, right? This LIBOR started quoting way back from 1970 onwards. And in those days, until I would say until 2008, the rates are all based on expert judgment. Basically, every bank used to come and give the rates basis their interbank lending rates. And what happened in 2008 subprime crisis is that all these rates, which used to come from the actual quotes that they are that are being transacted, it kind of moved away from the actual transactions to expert judgment. The reason being, there are a lot of liquidity crisis that has hit the market. And because of the liquidity crisis, a lot of the LCR and NSFR kind of regulations have come up into the market. And that actually meant that banks are no more incentivized to do the lending or to do the transactions in the interbank market. So they started doing a lot of, they started getting funds through fixed deposits, sticky fixed deposits, etc. So what used to be based on the actual quotes have started becoming more and more based on the expert judgment. And the panel banks that are involved in the LIBOR quotation, I'm just showing you, these are all multiple global banks ranging from JP Morgan, Barclays, BNP Paribas, etc. And once it started moving away from what is coming through the real transaction based to expert judgment, obviously there is a scope for the manipulation of these rates, and that actually led to a lot of these LIBOR scandals, which we started hearing from 2014 onwards. And just to give you some of these LIBOR scandals, I think it started from 2012. First of all, Barclays scandal has come out, and then there are at least 7 to 8 different scandals that have come out where people are rigging the LIBOR rate on the day of the payment of on the day of payment of their LIBOR, say LIBOR loan payables or even on the derivative side. So given that it is a panel, it's a panel of banks which are giving the quote together, it is possible to rig the rate. So once this has come out into the public, then obviously a lot of the regulators, including the FCA, has woke up and said that, hey, look, I think these rates are getting rigged, so we need to do something. So just to, I think before talking about the scale of the problem, just letting you know in terms of the major issues that you see, as Ajit mentioned, I think it was around $400 trillion in terms of just the millions of contracts that are referencing LIBOR starting of 2020. Now it started tapering over a period of last 1 year. Still, it is substantially high at 280 trillion. And it includes across the length and breadth of the loan market as well as the derivative market. If you see a lot of the transactions globally also on the loans or the credit cards or the securitized products or the bonds or the OTC derivatives, everything is somehow linked to the LIBOR. So if you are talking about a transition of LIBOR, then you are not talking about a small transition. It would be much bigger than even a Y2K or a MIFID transition or a capital calculation transition and everything. This has to be a much bigger than that. And also on top of it, given that these Libor scandals are becoming rampant, what the regulators have said is, okay, so we will do this transition in a 3-step phase. So there are 3 pillars of reform which they talked about. The first pillar, what they say is, okay, Libor, if you notice, I think before 2014, it is quoted across multiple tenors like a 1 week, 2 week, 1 month, 3 month, 4 months, so on and so forth. They said that all the Libor quotes which are not liquid, let's just remove them and have only liquid tenors. And for the non-liquid tenors, let's continue to use some kind of a quantitative modeling to calculate the Libor transition. So that is the first pillar of reform they have come up with. The second pillar of reform, they said that, okay, the first pillar is just a short-term one. The second one is kind of long-term, where they said that a lot of the Libor transition, Libor contracts which you are looking at, like the loan contracts or the derivative contracts, so on and so forth, the major problem is there is no effective fallback language in those things. When I say fallback language, what it means is any derivative contract or a loan contract should clearly have what will be the payable rate in case Libor is not quoted on that rate. So it should contain an alternative rate, what we call as a fallback rate, an alternative spread, what we call as a fallback spread, and also what is the trigger event. When will this fallback get triggered? Is it when Libor is not quoted for 1 day or 2 days or 7 days, or what exactly is the trigger point? So these 3 things are clearly missing. I think if you look at any of the contracts that are written before 2017, these 3 things are clearly missing from all the derivative contracts as well as the loan contracts. So what essentially happened is, in case Libor Libor is published, he stopped publishing, then there is a clear problem that we cannot settle all these transactions anymore. So what FCA has told all the banks is that create a robust fallback language for all these contracts in case what will happen if Libor is not quoted going forward. So that is the second pillar of reform which they started talking, and a lot of the global investment banks actually started doing that from 2017 onwards. The third pillar of reform, for which I think we are all in the room and trying to decipher what exactly is this thing, is moving away from Libor and coming up with some alternate reference rates. So again, let me move to the next slide. Yeah. So what all the G5 currencies have done is that they started forming individual working groups, and that working groups comprised of people from investment banks and from the clearing houses, from the insurance firms, from the clients, and from the consulting firms, etc. And they all brainstormed, and they all came up with 5 different alternate reference rates for each and every currency. They said that these are the rates which cannot be manipulated as easily as Libor. The reason why they cannot be manipulated is because these are all inherently based on transactions, and anything that is based on transactions and the volume of transactions is big enough, then it is not easy to manipulate those rates. So for example, dollar Libor, if we say, the alternate reference rate that came up with is what we call as secure overnight funding rate. The secure overnight funding rate, what we call as SOFR rate, this is completely transaction based. Number one difference between Libor and ARR. The second difference is that this is just an overnight rate. This is determined basis the overnight repo market, overnight lending repo market that you see in the that you see in US, and they included not just the banks, but they included a lot of other financial institutions also to make the rates more reliable. And but it is an overnight rate. I think that's the major difference between Libor and all the other alternate reference rates, that there is no term structure as yet defined for them. And similarly, I think for Euribor, also there is an Ester rate. For GBP, there is SONIA, so on and so forth. But one, again, difference between these rates also, if you are looking at dollar and compare it with, say, GBP, dollar SOFR rate is a brand new rate which has come up in 2018, whereas GBP Libor is replaced with what we call as a SONIA rate, Sterling Overnight Index Average. This is there from times immemorial. It's just that they reformed it. And again, this is also the overnight unsecured lending rate, but they just reformed it, and by including more and more participants to increase the volume of the GBP Ester alternate reference rate. So moving on, the major difference, if you can look at it as I mentioned, is that these are all close to risk-free. because these are all based on overnight and these are all based on secured rates. For example, dollar LIBOR, there is a treasury collateral that the person needs to post. So in that sense, it is more risk-free, whereas LIBOR is has some credit risk premium. It is essentially, by textbook definition, I would say it is a lending rate between two banks which are rated AA. So there is a credit risk premium on top of it. So these alternate reference rates do not include the credit risk premium. The second thing is that these are all overnight rates. The third thing is that given that these are overnight rates and do not have a credit risk premium, we need to identify what is the credit spread that need to be added to make both of these equivalent. Once, say, for example, if there is a loan transaction which is called as a LIBOR plus 200 basis points, if I'm moving away from LIBOR plus 200 basis points, what will be the spread that I need to add, what we call as a margin? That won't remain at 200, it would change from 200 to something different. And what is the different number that need to be calculated is the question that globally everyone is trying to answer. Moving on. So in terms of the timelines, I think just a background around this thing. So this, as I said, this right after the manipulations came into picture, I think way back in 2012, people were looking at the IBOR transition timelines, how we are going to do the transition. From 2014 onwards, there were several discussions that are going on. And the first attempt to actually come up with an alternate reference rate started from by FCA way back in 2014. And I think from India point of view, I think there was no action until 2019. Whereas in 2020, Indian Banking Association, IBA, has come up and asked every bank to assess what is their LIBOR exposure and the MIFOR exposure. For people who want to understand what is MIFOR, it is a Mumbai Interbank Forward Rate. This is essentially a combination of the way it is derived is a combination of LIBOR rate and dollar INR exchange rate premium. So any impact on LIBOR would directly impact the MIFOR rate. And generally what the corporates do, as you all know, once they borrow in dollar, we do a cross-currency swap to convert all the dollar borrowings into INR. And in that cross-currency swap, the INR leg will be MIFOR. So any changes in LIBOR will directly impact the MIFOR also. So IBA has asked banks to do that assessment. And in fact, even Reserve Bank of India has asked all the banks to do all this assessment and also come up with an IBOR transition roadmap way back in August 2020. And in terms of the global changes, two clearing houses like London Clearing House and also Chicago Mercantile Exchange, both these clearing houses have changed the discount rate from LIBOR to alternate reference rate already to SOFR and SONIA respectively. And in terms of the global impact, SOFR term structure is expected in somewhere around Q2 or Q3 of 2021. Similarly for SONIA also. And one major announcement that has come up as recently as a couple of weeks back is that a lot of FCA followed by Federal Reserve and all have come up with a clear guidance on transition of all the G5 currencies, clearly saying that they cannot maintain any positions in GBP, Euro, JPY and CHF in LIBOR beyond 2021. For dollar, because the impact is going to be significantly high, they came up with a reprieve to a lot of the banks as well as the customers, saying that 1 week and 2 month LIBOR will be stopped, whereas the more liquid LIBOR tenors like a 3 month LIBOR and a 6 month LIBOR will continue till June 2023. And again, once they were very clear, even if it continues till June 2023, they are expecting all the banks to move away from LIBOR as much as possible by end of December 2021, and beyond end of 2021, they should keep only those positions which are what they call as tough legacy transactions, which is not easy to transition over a period of next 6 months or so. And also, they said that any LIBOR transaction that need to be done say beyond 2021, it should be more of a hedge transaction to reduce the exposure of the banks. But it should not be a speculative transaction or giving loans to the customers in LIBOR linkages going forward, because that way banks are actually increasing the exposure, and that is against the spirit of the LIBOR transition in the first place. And again, what banks need to do, I think a lot of the global banks have already done a fair bit of progress. And from the Indian banks point of view also, A lot of the banks have performed the impact assessment and exposure assessment of all this, and they have analyzed what shall be the IBOR transition roadmap over the next 6 months to 9 months, how I'm going to transition this, and how I'm going to communicate to the counterparties in terms of what the transition is going to be, and what will happen to the repapering. I kind of touched upon it. A lot of the contracts do not have the fallback language. So what should the banks do to incorporate that fallback language? That is something which banks are discussing right now. And most importantly, a lot of the banks, I think all the banks use a lot of systems and vendor systems, etc. So there will be an impact on the vendor systems also. Banks are discussing with the vendor systems also. Vendors also how to upgrade the systems to do all the ERR-based loans and ERR-based derivative valuations and risk assessment. And I think there is not much progress on the accounting and tax side, but there is fair bit of discussion at least, and people are waiting for a complete guidance from the Reserve Bank of India also on what need to be done on the accounting side as well as on the tax side. Whether it will have a direct tax impact, because what essentially means is when you are talking about repapering, you are closing out one deal and repapering the new deal. Moving on. I kind of covered a lot of these points. How does IBOR transition impact India? I think India is not insulated from the global markets. Just to give you some high-level numbers, MIFOR exposure itself is greater than $1 trillion across all the Indian banks. And transitioning from Libor will largely impact the foreign currency loans and also the syndicated loans market. And for even the corporate sector also, all the ECBs, what we call as an external commercial borrowings, will get impacted because of this Libor transition. And there might be a situation where, in case banks do not do the transition, I think that's in terms of the challenges that the banks would face, is that in case the transition is not going to happen, then we are not able to borrow or lend in the foreign currency market anymore. Because the interbank market or the global players are not ready to transact in Libor anymore. And that would actually mean that we are exposing ourselves to a real major risk. But the transition, as I said, is not very straightforward, because there is no term structure that is available. What it essentially means is that if there is no term structure available, all the 3-month SOFR rate or 3-month SONIA rate that need to be calculated, there are some backward compounding statistical methodologies that the people are coming up with. But obviously, there is a lot of debate that is still going on how to calculate the interest rate, etc. And ISDA has actually come up with a protocol as recently as in January, where they have clearly articulated how the interest would be calculated for all these borrowings, and how the valuations need to be done for the derivative transactions, etc. And even the Loan Market Association, LMA, has also come up with clear guidance on what need to be done for all the existing transactions once you transition. If you want to transition from Libor to ERR, what is the impact that is going to be? So a lot of things are happening at the background globally. But one thing which I would like to emphasize to all the people in the call is that this is something which is globally driven, and this is not driven by any particular bank or etc. So this is and the impact that is going to be universally determined basis the methodologies which are determined by the regulators and by the global industry bodies, and hence whenever the transition happens, each and every bank would try to make it extremely smooth for both the customers as well as for themselves, as well as for the system vendors also. Yeah, let's just stop here. In terms of global market developments, I kind of covered these things more or less. So major global market development is that large international banks are ready to transact in ARR. Specifically, the likes of US banks are already doing trades in SONIA and SOFR, etc. And regulators, specifically, just a comforting factor for all of us, are very much monitoring and accelerating this transition. So rest assured that there is no concern, because at least a lot of the global regulators are asking banks to publish their IBOR exposure, and if it is tapering or not on a monthly basis also. Even RBI is asking all the Indian banks to do so. And in fact, ICE Benchmark Administration, which is a publisher of the LIBOR rate, has recently released a consultation to cease publishing of some of these LIBOR rates. And some of the other tenors of LIBOR, like a 3-month and 6-month LIBOR, which I was talking about, will be published till June 2023, but the methodology would be slightly different. It will not be based on poll-based way. So market manipulation, the opportunity of market manipulation would go down significantly. Even these rates would be determined as a function of the traded volumes in the market. So beyond 2021, I wouldn't see any kind of a, hopefully, I wouldn't see any kind of a market manipulations as such in determining the benchmark rate. And the transaction would be, and the world will be much more different than the world that we are dealing currently right now. Okay, back to you, Ajit.
Well, thank you, Subbu. Thanks a ton. I think that was a pretty comprehensive and pretty crisp kind of overview of how the market has been the last few years or decades, and how LIBOR came about being, and there's a little bit of history on that, and why it is so important today, and giving the Indian as well as the global context to how this transition affects us from a macro point of view. Now to kind of give a little more detailed and a micro view on how it affects in terms of the transactions, the loan agreements, the derivative deals, and so on. I think we have Sumit with us. With us to kind of give us an overview and maybe also a detailed explanation on certain aspects which are more going to affect us a lot more immediately, especially on the derivative deals and something which has been signed for long tenors and has to pass through this transition as live deals. So yeah, Sumit, over to you.
Okay, thank you, Ajit, and thank you, Subbu, for the nice introduction into this topic. Now that LIBOR is definitely going away, what I will try to focus on is what are the next steps for us, and what do we need to do given that LIBOR is no longer going to be with us beyond the given timelines. Just on the timelines part, Subbu did mention them. I will just reiterate the timelines. So this has been announced officially by the regulators on the 5th of March that Euro LIBOR, CHF LIBOR, GBP LIBOR, and JPY LIBOR will cease to exist on the 31st of December 21. US dollar LIBOR, 2 tenors will cease, but most of the rest of the dollar LIBOR curve will continue until 30th of June 23. Now, as far as US dollar LIBOR is concerned, and majority of our exposures are, majority of the exposures in India are linked to US dollar LIBOR loans and derivatives. These deadlines, the 30th June 23 deadline is more for the legacy contracts. What the regulators have been very clear about is that banks are expected to move on to non-LIBOR linked loans and derivatives from the 31st of December onwards. It's 31st of December 21 onwards itself. So essentially, you may not expect, you should not expect any kind of new LIBOR linked derivative or a loan after 31st of December 21. However, having said that, LIBOR will still be around to value our outstanding derivative and loan contracts. Just another point to mention is that while the 30th June 23 is a deadline and it is a timeline, and it's not likely that LIBOR will cease before that, but there is still a small possibility that LIBOR becomes completely illiquid, and regulators call it an end to that to the benchmark even before that. So that's something to be kept in mind as well. Now, in terms of how does the LIBOR rate get replaced with the new alternate reference rates? Now, the top part of this slide highlights that today, when we price our LIBOR-linked derivatives or loans, we have a LIBOR rate available with us at the start of the interest period. So we know what, for instance, let's say we have an interest payment between 16th of March and 16th of June. We know what the LIBOR rate is on the 16th of March and to be paid on the 16th of June. Now, going forward, as Subbu said, this is getting replaced with overnight rates. So this is a one-day rate, which is in the US, this will be called the secured overnight funding rate. And essentially, this rate has to replace something which is something like a 3-month LIBOR rate. Now, that of course is a challenge because one is an overnight, the other one is a 3-month rate. So the methodology which has been becoming popular and which has been proposed also by regulators is that we will observe the overnight rate for the entire interest period. So every day's overnight rate will be observed, and we will wait. And on the last day of the interest payment, we will look back the fixings of all the overnight rates, arrive at a compound average of that, and that will be one way of arriving the risk-free component of LIBOR. Now, of course, LIBOR is an interbank rate, so there is also a credit risk embedded in that. So on top of this compounded average rate, there will be a spread adjustment that will have to be added, together this compounded average plus the spread will replace the LIBOR rate that is embedded in our outstanding contracts. So, and as far as the spread is concerned, with the 5th March announcement, the official announcement from the regulators of the timelines, the spread has also been fixed and now is now available. So it can be visible on Bloomberg screens as well as on other market data sources. If our clients need to know what are these spreads, we can also get in touch with your respective coverage managers. In terms of what has been the adoption of these alternate reference rates, so these are some data from the ISDA, from the International Swaps Derivatives Association of India, Derivatives Association, ISDA. What they monitor is an indicator which shows the total notional in RFR swaps. Now, RFR stands for risk-free rates. These are the alternate reference rates that will replace LIBOR, versus the total notional in derivatives being traded. So the left side of the chart shows this line, and it's currently stands at 11%. Now, this is a monthly data, and it's the last data point available is as of Feb end. 11% itself sounds too low, and it looks like that the current adoption is not very significant. But what is expected that 2021, this particular year, is when this line is expected to peak, because expected to rise significantly, because most banks are now actively working towards this. Probably one of the challenges that has been is getting systems ready to deal with this new way of computing rates. And most banks are now working on it. And once they start getting ready, we will see an uptick in this adoption rate. Also, in terms of different types of currencies, as Subbu mentioned, GBP Sonia has been around for quite some time, and there has been a good amount of progress made there. So, in terms of the adoption so far, the pound has around 45% of adoption in globally right now, while other currencies are the adoption is pretty low compared to expectations, I would say. The dollar adoption, of course, is also around 5%. A point to make here is that the UK and GBP, they're of course ahead of the game. It appears from this data. And so it is worth observing what developments are taking place in that jurisdiction, because that is likely to potentially become the global trend going forward. Now, Subbu also talked about MIFOR, which is a rate which we use in our cross-currency swaps. So if we have a dollar rupee cross-currency swap, on the rupee side, the interest rate exchange is the MIFOR interest rate. Now, MIFOR is a derived interest rate where it is computed out of forward premiums in USD INR exchange rate market and the US dollar LIBOR. Now, given that LIBOR is going away, there has to be some adjustment to MIFOR as well. Some methodologies for treating MIFOR have been proposed and have been published by the Financial Benchmark India Limited, and is available on their websites. The modified MIFOR is the MIFOR which will be used for new derivative contracts where MIFOR is used. And that methodology is available on the FBIL website, is still under discussion. It's a draft proposal. And very soon they're likely to finalize this methodology, and we'll have the MIFOR rates methodology available with us as well. Now, in terms of what do we need to do to modify our contracts, again, referring to Subbu's presentation, he was talking about that we don't have any fallback language in our outstanding contracts. So if LIBOR was to permanently cease, there's no way we can switch onto something else unless we make some amendments to our outstanding contracts. Now, what ISDA, being a global body for derivatives, has proposed is the ISDA protocol, which has been effective since 25th of Jan 21. Essentially, what does it do is that it introduces an extra supplement, it introduces an extra attachment to our ISDA documents, which allow us to change LIBOR onto the new reference rates. The reference rates, for instance, for US dollar LIBOR is the SOFR rate, which we discussed earlier, and the spread, which has been computed by Bloomberg, which was also fixed on the 5th of March this year. If we were to sign the ISDA protocol, then the methodologies mentioned in the protocol will be applicable to our outstanding derivative contracts. And so, as a general advice, all clients who are holding onto derivative contracts, especially which mature beyond the transition dates, they must consider looking at the ISDA protocol. From our side, we will encourage our clients to consult their internal legal departments and consider adhering to this protocol, because the protocol is becoming quite popular across the market. As of 16th of March, around 13,500 entities have already adhered to it. Within India, there are 150 entities which have adhered. So this is something that must be done if we want to ensure that there is smooth transition in our derivative side. That's regarding our outstanding derivative contracts. Now, if we were to do any new derivative contracts, so what ISDA has done is it has modified the contract so that if we were to do any new derivative from 25th Jan 21 onwards, the new fallback, the new rates, which is, let's say we do a LIBOR transaction, LIBOR derivative today, and LIBOR were to stop existing after 30th June 23, then they will automatically fall back onto the new reference rates. So nothing is really needed. If you want to do only a new derivative contract, those will be automatically taken care of by the new ISDA definitions. One final point on another FAQ is that there is certain concern that, okay, what happens if LIBOR becomes illiquid after 31st December 21, and you want to switch out of LIBOR even though it is getting published, but it's not something that which you're not very comfortable with. So in that case, a bilateral agreement will be required between the two entities. So, for instance, if the agreement is between Axis Bank and a client, so the two entities will have to get together and sign a bilateral agreement, which will allow you to switch out of LIBOR before the transition dates onto something else. In terms of how can we adhere to the ISDA protocol, this is a fairly simple online process. We are required to go to the ISDA website, so www.isda.org, access the protocol section there. There is an adherence letter, which has some fields to enter. So as you enter the field, there will be a populated letter generated. You can either download that directly from the website or get an email to yourself. You have to then sign the adherence letter, upload it back onto the website, and then await confirmation from ISDA. That's mostly about it. And so that's something that needs to be needs to be seriously considered if you have outstanding derivative contracts, and especially if they are maturing beyond the transition dates. Now, coming on to the loan side, just like the ISDA protocol or the ISDA agency, there is not much standardization in terms of loans when it comes to replacing our LIBOR-linked loans with the new alternate reference rates. There's no such protocol being announced, and it's not expected that any regulator will tell us what methodology to use for loans. But what has been proposed, there are different methodologies, different approaches which have been suggested, and I will discuss those in the subsequent slides. And it is basically between counterparties or between bilateral entities to negotiate the methodology bilaterally and arrive at the methodology that you have to use for the outstanding LIBOR-linked loans. Now, one of the biggest challenges that we have with loans is the idea that LIBOR today is a forward-looking rate, while the new rates will be only overnight rates. So if, let's say, you want to know a 3-month rate, as we discussed earlier, that has to be a backward-looking rate. You can only know what will be your 3-month rate at the end of the interest period instead of at the beginning of the interest period. Now, many customers may not prefer this because it does not allow enough time to know how much is the payment to be made, and essentially there's not much gap between the time when you know the rate and the time when you make the exact payment. So that's the biggest challenge that we have on the loan side. But having said that, another consideration is that if we were to adopt a different methodology for loans, which is, say, different from the derivatives methodology, and if you are running hedges between loans and derivatives, there's a risk that the hedge breaks down. So essentially, if you were to, say, arrive at a forward-looking rate for loans and use a backward-looking rate for swaps, the two will not match each other, and that's a risk that we run with our outstanding hedges. So generally, it's very likely that the loan market gets split into two types of products, and our customers may demand different types of products. So one could be a forward-looking rate product. Generally, one of the ways by which this could be achieved is that we can look back at the rate that was there for the previous interest period and apply it for the next interest period. So for instance, if you're looking for a loan which has an interest lying between 16th of March and 16th of June, we can look back between 16th of December and 16th of March, see the observation of rates during that period and apply that for the next interest period. Of course, this is not the best methodology because this is not the best approach because it doesn't capture the interest calculation during the period for which you're paying the interest. But still, it's the advantage is that we will know this rate at the beginning of the interest period. For some of the products, especially some trade finance products, this is a methodology that is possibly likely to be followed. So, for instance, if we have a bills discounting product where the rate the rate is discounted till today from the forward date, then in that case we do need a forward-looking rate, and this is one of the approaches that could be used. And in some of these products, the sensitivity to using a backward-looking rate to using a rate which was fixed during the last interest period versus the rate which was used for the falling interest period may not be that great. So it may not be that large. So therefore, it's possible that we may go ahead with this kind of approach for some trade finance products. But of course, this forward-looking term rate arrived in such a manner cannot be used for if you were to run hedges against derivatives, because the derivatives methodology is all fixed, and that's not likely to change. On the other side, on the right side of the screen, these are the methodologies which are most likely to prevail for most of the other loan types of products. So again, this will be a rate known in arrears, which means the rate will always be known at the end of the interest period. But of course, the challenge with this is that this gives little notice between the time when you know the interest versus the time when you make the payments. There are some methodologies, some midway approaches which have been proposed by regulators and by different market participants, and I'll talk about those. And those allow some sort. So even if you were to follow overnight rate in arrears, you will still get some sort of a time to deal with the issue of knowing the rate versus the payment date. And here are the different methodologies which are becoming popular in the loans market. The number one box here talks about simple interest. Again, this is in arrears, and we look back from the interest payment date and compute that rate on a simple interest average. So this will be, instead of using a compound average, which is the common way of computing interest rates in the financial world, we will, instead of that, use a simple interest computation. Now, this is being proposed by the regulator in the US because it's an easy way to compute, and the systems are easy to develop if you were to follow this approach. And in some of the contracts, and we'll talk about contract remediation after this slide, but there also the regulators proposing that this is one methodology which could be used for loans, for some loans. Of course, there are some challenges in this approach. It will not match derivatives, and it will also it's also not the right reflection of time value of money, which is generally based on a compound interest formula. The second approach is the payment delay. Now, this is essentially exactly replicating the derivative payments. So derivatives work on an OIS swap or a SOFR swap will work on a T+2 settlement basis. So we will run our so we will wait until we're talking about an interest period of 16 March to 16 June. So we will wait until 16th of June, but then there will be a 2 days lag provided there to allow for payments. So essentially the payment will be on the 18th of June. Now, of course, this completely matches the derivatives payments, but still the lag between the time when you know the interest versus when you pay the interest is still very small, and there's a bit of a challenge in using this approach. But if clients were to run hedges between loans and derivatives, this is one approach that could be looked at. The other approach, and the third approach, which is becoming most popular across different jurisdictions, is the look-back approach. Essentially, let's say we apply a 5-day look-back approach. What that means is that if we were to take an interest between 16th of March and 16th of June, we will shift our observation period by 5 days. So for instance, if we want to know the interest rate for the 16th of June, we will apply all the overnight interest rates until 11th of June. So we'll shift our observation by 5 days. And on the 11th of June, we will know what that interest is. So by 11th of June, we will have an idea of what is the interest payment to be made by the 16th of June. So there is a 5-day gap during which, so there's a 5-day period for which the interest is known, and it is in that time that sort of time is available for the borrower to make payments. And again, apart from this 5-day shift, the rest of the calculation is all similar to derivatives. So while there will be still some basis between loans and derivatives, but still that basis will be quite small, and it's quite possible even this approach could be used for hedging loans and derivatives. And the final approach is what they call the lockout approach. Essentially, what this means is that the rate which is available, say 5 days ago, is locked for the remaining period. So for instance, if we are expecting an interest payment on 16th of June, the rate mentioned on the 11th of June will be locked for the remaining 5 days. So essentially, we can work out what's that interest payment on the 11th of June itself. Again, this gives some time to the borrower to make payments, but given the lockout in the last few days, this may not be exactly matching the derivative payments, and that's a bit of a challenge in this approach relative to the look-back approach. Yeah, I'll skip this slide. So finally, on the contract remediation part, again, on our loan side, we face a similar challenge where we have to amend our contracts to replace LIBOR with an alternate reference rate. Now, as I said, there's no ISDA protocol available here. There's no such document available here, which can be done universally. What is needed is that banks and counterparties need to sign agreements bilaterally. What is regulators? There's the Loans Market Association and the Asia Pacific Loans Market Association have proposed certain languages within which we can introduce in our contracts. In fact, banks are already introducing these contracts, and you might see this language already in your contract. What this is, it allows for a replacement of the screen rate. So essentially, it says that it's called a replacement of screen rate clause within your contract, which says that you can replace the LIBOR rate or replace the benchmark rate with an alternative reference rate in case there's a screen rate replacement event. So this sort of a provision is being introduced by banks, and some of the important terms which are mentioned in this clause include, I'll just read out, for instance, if a screen rate replacement event has occurred, it provides for the use of a replacement benchmark and allowing that replacement benchmark to be used for the calculation of interest. And it's arrived at with the consent of the agent or the lender and the borrower. And of course, we will also have the mention of the screen replacement benchmark in terms of. So this will be more in terms of replacement benchmark. This will be a more loosely worded statement because it will say that we can use a benchmark which has become popular in the market, something like that. But it does not. But one. And now this comes to the third point, and one part which is not yet covered in this replacement of screen rate clause is that it doesn't tell what will be that rate which will replace LIBOR. So essentially, given that the market is not yet developed and we don't know what is the methodology that is likely to become popular, so therefore this part of the contract, which is what will be the new rate, is not yet embedded into our loan contracts. So what is needed is that if you have a loan which is expiring beyond the transition dates, some sort of an amendment will be needed in those documents to introduce this fallback methodology, which will tell us the methodology of the new rate which will be used for computing the new interest rate. So essentially, the current contracts, most of them should contain the replacement of screen rate clause, which allows for a replacement of LIBOR, but it doesn't tell us what will that replaced rate be. So essentially, we need to make one more amendment as we go down the line prior to the transition date, which will ensure that we introduce a language for the new methodology that we have to adopt for computation of new interest rate. Okay, so thank you. So that's my part of the section, and we'll be. I would like to thank everybody for this opportunity, and it'd be great if you'd like to come up with some questions, and we can discuss those as well.
Yeah, Sumit. So I guess we can start off with the Q&A session right away. So first of all, thank you so much for kind of leading us into that micro view of how it's going to affect customers in terms of the transactions that they have with banks, the loans and the derivative transactions. Well, so we have some questions coming in from our customers, and we'll take on the first question. It's more about turning theory into practice. So the question reads, I have a fully hedged USD loan. What are the implications and what are the risks that I need to be careful of? So if I can just add on to that question. So let's say if we put out scenarios, because we have different timelines over here. So we have a loan that matures, let's say now before end of 2021, and another loan which matures somewhere between 21 and 23, and a loan that matures beyond 23, let's say 2025. How does this pan out in these different scenarios for a fully hedged USD loan that a customer must have? So Sumit, if you can take that question.
Okay, sure. So let's look at the different timelines. So if we have a loan which is maturing before 31st of December 21, then essentially nothing much needs to be done. I mean, the only risk is that LIBOR gets discontinued before the cessation date. There's a very small risk of that happening before 31st of December 21. As I mentioned, currently only 10% or 11% of derivatives are denominated in the alternate rates. Remaining 90% continues to be denominated in LIBOR. So there is a less risk that LIBOR gets phased out before the mentioned timelines. So essentially not much needs to be done if a loan is expiring before 31st December 21. If a loan is expiring between, say, 31st December 21 and 30th June 23, if it is a dollar LIBOR dollar loan, then nothing much needs to be done. Again, we can expect LIBOR to get published, and those will be used for calculation of interest payments. But if it is another currency, say GBP or Euro denominated loan, then yes, then some contract remediation is needed. What is essentially needed is that you need to get in touch with your bank and agree to a new methodology for applying to your loans. And if there's a loan maturing beyond 30th of June 23, so yes, so those definitely need to get remediated between yourself and your bank.
Right. Thanks. I think that clarifies quite a bit.
Can I add?
Please, Subbu, if you want to add on to that.
Sure. So specifically, I understood from the question. So you have a loan and a fully hedged derivative. So as Sumit rightly pointed out, with respect to the different maturity dates, but there is a different perspective also. What is happening right now is there are some loans, there might be a transition timing mismatches also, which might result in the hedge breakdown also. So what might happen is you are transitioning away your derivative, because derivatives markets are much more advanced compared to the loan market. So derivative you are transitioning, for example, into SOFR or alternate reference rate, and you are still having loan continuing to be in dollar LIBOR, then you are having that risk between dollar LIBOR and SOFR basis. So that risk need to be assessed appropriately, and accordingly some basis swaps need to be done to ensure that there is no P&L impact on your books. So that is very, very critical, given that we are not expecting everything to move together on one day. Come this 31st December, everything will go together. That's not going to happen in the real life.
All right. Thank you so much. Well, we have the next question. Subbu, this one is for you. So one of our customers says that LIBOR measures, the same market of all in all the currencies. So there's a certain sense of homogeneity because it is published by the same entity, and the way to go about arriving at those rates, even if it is for different currencies, there's a great deal of homogeneity in that. Whereas when we are transitioning to these risk-free rates, and then whether it is these are unsecured rates or secured rates, for example, the US dollar and Swiss franc will be based on secured market rates. The Japanese yen, the euro are based on unsecured market. So there is that homogeneity aspect will go off. So will that, how much of a difference does that make?
Yeah, that is a very good question actually. But we need to think of it in a broader perspective, right? As in, yeah, I agree that homogeneity is going away, given that everything right now is published by ICE Benchmark Administration, and the way they are quoting, the way they are computing is similar. Whereas right now, if I'm moving away to the alternate reference rate, like the way SOFR is published, the way and the timing of the publishing of these alternate reference rates is also now different going forward. There is a concern there. I agree with you. But obviously, the pro that you are getting by moving into alternate reference rates far outweigh the con, right? And then you can clearly see there are a lot of problems in LIBOR continuing to be used as a benchmark rate. And even IOSCO, as per the IOSCO principles also, there are some guidelines which identify whether any benchmark can be used as any rate can be used as a benchmark or not, and LIBOR does not qualify. And just think about it. Then homogeneity is gone, but you are getting a rate which is more reliable and which is less prone to manipulation, and that should be definitely good for the customers. But the real problem of valuation will come into picture. As in, if you are valuing a cross-currency swap, etc., where right now it's a dollar LIBOR versus GBP cross-currency swap, it is much straightforward than a SOFR versus SONIA cross-currency swap, because there are three different risks that you need to consider, like SOFR LIBOR basis and as well as SONIA LIBOR basis and whatnot. I think a lot of complications would come into picture. But I assume that the market is going to bake in all these things, and a lot of the vendors are building the necessary tools and accelerators to do all these things. But I would say that cons are much lesser compared to the benefit that we are getting.
Thank you so much, Subbu. Thank you so much. Well, the next question, it seems like a pretty simple question, but a very relevant question in the day-to-day, handling of things for a typical Indian exporter or importer. The question is, as an importer or exporter, how is it relevant to me? How is this entire process of LIBOR transition? Is it at all relevant to usual importer or exporter, where the usual, if they have usance bills to be paid out or to receive, which usually have a tenor of maybe at max 3 months or 6 months, is this relevant to them? Any one of you, maybe Sumit, if you can just touch on that.
Take that. So essentially, if you're an importer and exporter, and if you're running hedges against the receivables, so let's say you're running either an FX swap, or even if it's a cross-currency swap that you're running against your receivables, so those can get affected. We talked about cross-currency swaps and how the LIBOR rate and MIFOR rate will get affected in those. On the FX swap side, while the FX rates itself are not expected to change, but when we do the valuation, at least, when we do the mark-to-market valuations, there's a discount rate that is used, and those are based on LIBOR and MIFOR. So given that those will change, some sort of a discount or valuation impact is expected, and that's something that's where it might affect you.
Yeah. Well, thank you so much. Subbu, I have a question for you. Will MIFOR follow the same principle, that is SOFR plus overnight forward premium compounded daily? Given that SOFR is an overnight rate, will this how it will pan out? I mean, that's a clarity.
Yeah. Okay. So there are two things, right? And then in the short term, and I'll also talk about the long term. In the short term, as long as LIBOR is there, MIFOR, as it stands today, it's just a sum of LIBOR and for dollar INR exchange rate premium. So just replace LIBOR with a SOFR plus the LIBOR SOFR spread methodology. And ISDA has come up with a clear protocol that LIBOR SOFR spread is nothing but a 5-year median spread between LIBOR and SOFR for that particular tenor. So if I have to calculate, say, MIFOR 3 month, say after transition, it will be simply that it's SOFR plus 5-year median spread between LIBOR and SOFR and the dollar INR exchange rate premium. So the calculation is going to be pretty straightforward. But in the long term, if I'm talking about the long term, then there are a lot of discussions, right? And then IBA has actually conducted a survey asking all the banks in India as to what do you want to do? As in, do you want to continue with this kind of a MIFOR at all? Or you want to move into something very different? For example, I take the example of UK market. UK market has only two curves. One is a domestic curve and the second is cross-currency curve. And they use both of them just to do any kind of valuations. Whereas in India, you see, I think there are a lot of curves, right? There is a MIFOR curve, there is a MIBOR curve, there is an OIS market. Things are becoming a little bit more complicated in that sense. So there is a survey that is conducted across all the Indian banks. The results are not yet out, but asking for the opinion if we want to move into the cross-currency market and move away from MIFOR. but I would say that is going to be a little longer term. But I think the banks are, the way IBA and RBI are thinking, they are moving in the right direction. There is no need to have a MIFOR rate if you build a sufficiently liquid cross-currency market. So to answer the question, the short term, there is no problem. It's just a replacement as per the SOFR plus average, the 5-year median number. And the long term, things are still evolving.
Okay, just to add to that question, Subbu, I mean, I clearly get a feeling that things don't seem so. The path doesn't seem so clear as yet. So, do you see this opening up the doors for more fixed rate loans in the future, at least for some time till clarity comes back as it is today? I mean, how it was for LIBOR. Do you see a transition period where this clarity will not be there, and hence it will lead to more fixed rate loans, and if at all, it will have a larger impact in the the credit markets of these 5 LIBOR currencies?
I think that depends on how your funding is coming also, right? And then from the loan side, you can do a fixed rate loans, but for the customer, as for the banks, the funding is still based on LIBOR. Then you are still opening up that gap, right? As in, still you are not completely hedged. If your funding in the interbank market is also fixed, and you are giving loan also in the fixed rate market, in the loan market in the fixed rate, then it is fine. But what typically happens is your funding continues to be in LIBOR, or maybe beyond 2021, it will become SOFR. But still you are doing a fixed rate loan, then you have that risk, right? You are still exposed to that risk of LIBOR and SOFR as well. So I really do not think that going towards fixed rate is a solution. The solution would be actually doing some kind of, I think it's like a chicken and egg situation, right? No, most of the people need to start trading in SOFR so that the liquidity in SOFR will increase. I think Sumit was talking about the liquidity in SOFR. So if the liquidity in SOFR increases, then it will become a reliable benchmark. Then it can be used as a funding curve as well as a lending curve. Then in that case, you are hedged. Then the bank doesn't have any risk, or even the customer doesn't have any risk.
Thank you so much. Well, Sumit, I have a question for you coming in. Apart from exposure as a corporate, I also have exposure through FCNR deposits. This is an interesting one. The deposit rates, the cost of leverage, and the hedging cost all depend on LIBOR. What are my options here? What do you have to say to that?
So, as far as FCNR deposit rates are concerned, these are rates which are generally set by banks. They use LIBOR in the background, but essentially it's not seen as a direct linkage to LIBOR. So essentially what we know is that there is a ceiling which has been proposed by the regulator for FCNRB deposits. That ceiling is likely to change, and this guidance is likely to come from the RBI. And so basically, this is likely to be driven by the RBI, and they are likely to propose a new methodology that can be used, or a new ceiling that can be used for FCNRB deposits. Other than that, mostly today banks use their own cost of funding to arrive at that rate. They're likely to continue to do that, but we don't see any direct impact on that because of this.
Right. Thank you so much. So we'll take the last question of the day, and Subbu, that question goes out for you. So I know in some senses this kind of got touched upon, but since this is important, LIBOR includes a premium for the interbank credit risk, right? And here we are the alternate reference rates that we're talking about. A lot of them are risk-free rates. So I mean, and these risk-free rates which are overnight and in some cases secured, do not include the premium or include a reduced premium. So do you see this having some kind of an effect in terms of how the banks fund themselves, or how that transmission is going to happen to the loans that they write with customers? Do you see an impact there?
Yeah, actually this is for the good only, right? And if you see, ideally in any global investment banks also, they want to segregate the risks in a very clear way. There should be an interest rate risk, and then there should be a credit risk. Both of them need to be segregated clearly so that they can hedge both of them separately. Interest rate risk can be hedged through an IRS, and the credit risk can be hedged through buying a CDS, etc. Right now in the LIBOR market, there is a combination. Basically, LIBOR itself is a combination of both interest rate as well as the credit risk. There's a credit risk premium also included in that. So it is becoming more and more murky. As in, if I'm talking about a customer who's, say, for example, in the global Moody's rating scale, say it is rated, say, for example, a single A. Then I say that the loan that I'm going to give to him, I'm going to charge, say, LIBOR plus whatever 50 basis points. But that 50 basis points essentially does not reflect the credit risk of that person.
Right.
That 50 basis points plus there is a credit risk that is coming in through LIBOR.
Correct.
What we are doing it, and then purposefully they did not thought about it, but there is an after effect of using the risk-free rates as a benchmark, and that's actually good for the markets, is that now you are able to segregate credit risk and market risk, interest rate risk very clearly. And the risk-free rates, which are used as an RFR's ARR rate, which is so far the SONIA, these calculate only the interest rate risk. And the credit risk artificially looks higher, basically because the LIBOR risk is also going into the credit risk. But people in the market will understand that thing over a period of time. And that would really help out in understanding and assessing and buying the CDSs, etc. for the banks as well as for the customers. And I think this is good in the long run for the markets.
Right. So you're basically saying that, in fact, this is like a blessing in disguise which is kind of coming through.
Exactly. Correct. Yeah.
Makes sense. All right. Before we close, I just wanted to add on one more part to that. Are there going to be any, Sabbu, again, this is for you. Are there going to be any reporting on compliance or, any changes coming through in the accounting standards and so on? Does this change warrant something of that sort?
Do
you see that coming?
LIBOR transition as it stands today, this is a market and valuation impact is higher than any accounting or tax impact for now. There will be a second effect on the accounting and tax, but which global IASB, etc., are also considering this thing. I was kind of touching upon that point previously as well. If there is if I have a underlying loan and a perfectly hedged derivative in my book together, and as per the hedge effectiveness rules, both of them can be clubbed together, and I can say that both the loan as well as the derivative are hedges. However, going forward, once because of the transition mismatches, timings, etc., say the loan is moving forward, whereas the derivative is not moving forward because of whatever the reason, then there might be a hedge breakout because the derivative might continue to be in LIBOR, whereas the loan I have moved into SOFR. So in those scenarios, the global accounting IASB standards have come up and they are saying that, I think this is not yet formalized, they are saying that if there is any hedge breakdown, they are going to give some reprieve to the customers if that hedge breakdown has occurred because of IBOR transition, at least in the near term. And I don't think this problem will be persistent, say, after the entire transition has happened. That is, after June 2023, when the entire book is transitioned into alternate reference rates, then the accounting standards will hold. I think this is only a temporary problem on the accounting side, which everyone acknowledges that. And to answer in a higher level, this is a major reform from the valuation and market side and not from the accounting and tax side. These are after effects which will be taken care.
Well, thank you. I wish we could have taken more questions, but given the paucity of time, and I think we wanted to kind of keep it within that usual time frame of 60-75 minutes that we do our usual webinars. So anyways, thank you all very much. Thank you all our customers for joining us. And on behalf of Axis Bank, that concludes the webinar for us. And I would just like to take a moment to convey our gratitude to our external panelist, Mr. Subramaniam Oruganti, for taking out his valuable time. And we look forward to all our customers joining us soon on our next edition of this knowledge series. Just to let you know, the recording of this webinar will be available in case you wish to have this passed on to some of your colleagues. So once again, thank you all for joining us. Ladies and gentlemen, that brings us to the close, and you may log out from the webinar now. Thank you so much.
you.